This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. The G7 and allies have shelved regular reviews of the Russian oil price cap scheme. People familiar with the matter told Reuters, even though most Russian crude is trading above the limit because of a rally in global crude prices. Russian producers have found ways to sell oil using fewer Western ships and insurance services, making it difficult for the West to enforce the existing price cap because the companies facilitating the trade are outside of their remit. The Group of Seven, G7, countries along with the European Union and Australia imposed a price cap mechanism on Russian oil last December, followed by a cap on fuel from February.
Oil prices reversed course on Wednesday after rising over 1% in the previous session, as investors shrugged off jitters arising from supply cuts from Saudi Arabia and Russia and a firm dollar capped the upside. Brent crude futures were down by 9 cents to $89.95 a barrel at 0657 GMT. U.S. West Texas Intermediate Crude, WTI, futures traded at $86.60 a barrel, also down 9 cents. Against a basket of currencies, the dollar equals USD was at 104.69, not far off the 6-month high of 104.90 touched overnight. A stronger dollar can weigh on oil demand by making the fuel more expensive for holders of other currencies.
Moving on to the top news in the energy sector.
India is seeking additional volumes of natural gas and has asked utilities to expedite completion of power plant maintenance, as the country takes emergency steps to arrest electricity outages, according to a government note seen by Reuters. The Power Ministry is advising states to expedite commissioning of all new power plants and operate gas-fired plants at full capacity, the note said. In order to cater to the high demand situation, all available resources in the grid are being harnessed. It is pertinent to mention that the entire onus of meeting non-solar hours demand falls upon the coal-fired generation, the note said.
Asian buyers will quickly absorb a surge in supplies of liquefied natural gas, LNG, coming to market over the next 5 years, an executive with Vitol, the world's largest independent oil trader, said on Wednesday. Supplies in the West are set to improve over the next few years, with U.S. developers of LNG on track to approve a record volume of new projects in the first half of this year. That additional volume is going to be absorbed very quickly, said Pablo Galante Escobar, Vitol's head of LNG and EMEA Gas and Power.
Next, we have the top news in metal markets.
The prices of most industrial metals in London fell on Wednesday, under pressure from a strong US dollar and looming demand worries amid a global economic slowdown. 3-month copper on the London Metal Exchange was down 0.5% to $8,442.50 per metric ton by 0735 GMT, while the most traded October copper contract on the Shanghai Futures Exchange ended daytime trade 0.4% higher at 69,490 yuan, $9,504.60 per ton. The dollar index was steadier at a near 6-month peak amid fears of more interest rate hikes after the comments by Federal Reserve Governor.
Iron ore prices rose on Wednesday, underpinned by expectations of resilient near-term steel demand in China, although gains were capped amid concerns about a slowdown in the world's second-largest economy and likely steel output controls. The benchmark October iron ore on the Singapore Exchange was up 0.7% at $115.75 per metric ton, as of 0700 GMT. It hit a 5-month peak of $117.25 on Tuesday, buoyed by China's policy measures to revive its faltering growth and struggling property sector. The steelmaking ingredients most traded January contract on China's Dalian Commodity Exchange ended daytime trade 0.1% higher at 853 yuan and 50 fen, $116.80 per ton. We will now look at the top news in the agricultural sector. Malaysian palm oil futures traded lower for a third consecutive session on Wednesday after bearish data on inventories pulled down prices and as the contract tracked weaker rival oils. The benchmark palm oil contract for November delivery on the Bursa Malaysia Derivatives Exchange was down 19 ringgit, or 0.49%, at 3,882 ringgit, $831.62, per metric ton during the midday break. Malaysia's palm oil inventories at the end of August likely jumped to a 6-month high at 1.89 million metric tons, as output rose and exports slowed, a Reuters survey showed on Tuesday.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.